Welcome to the Private Equity Experience Podcast, your backstage pass to the strategies, stories, and secrets that drive value in the PE universe. No filters, no fluff, just straight talk and expert insights to help you navigate the private equity world with confidence. And now your hosts, Ed Barton, Rory Liebhart, and Emily Sander.
We are back on the Private Equity Experience Podcast, and we are going to talk about management fees. So we talked a little bit about how a PE firm makes money last episode, but Rory and Ed, what do I need to know? What do we need to know about management fees?
You need to know I'm fresh in from Vegas, so if I come off as a bleary-eyed idiot, like I have an excuse for that. It's not my normal self. So,
but it was a business trip.
It was a business.
It was all
lots
business.
Of private equity related discussions and hobnobbing. And
there was a nice photo of you in front of that famous fountain or whatever.
Yeah.
The Bellagio fountains.
Yeah, exactly. Yeah.
You are you're the conference guy. If I never have to go to Las Vegas for a conference again, I'll be satisfied.
It's just one of those things that it's a necessary. I won't say evil, but I'm too old for this stuff.
I went to Vegas for 3 days for a conference, and I don't think I saw daylight once. That was how they get you.
That's how they get you. You said it.
It's brutal. It's brutal.
Yeah.
And what you're saying, Rory, is the truth. And I'm that much older than you are. You just can't. I mean, you come back and you're like, I need a vacation from
my man. I remember when we used to do it together. We used to divide and conquer these things, and it was a freaking marathon, man.
Yeah. But that's when I used to
debt buyer conferences. Oh my.
Yeah, debt buyers know how to drink. So
yeah,
and God bless. Did I have to? I was able to back in the day keep up, but I can't anymore.
I remember, Ed, one of the things you told me actually when I worked for you back in that time frame is, if you actually, I think I was asking you about, hey, should I get into business development and sales? You're like, you need to learn how to golf and you need to learn how to drink. And I'm not very good at either of those, so maybe I'll just stick with finance and all that stuff. So
it's a safer spot, pays better. Well, maybe not. Sales pays better.
Yeah,
but the two cross over. I mean, that's the magic.
There is some synergy amongst that. Yeah. Anyway, we digress as usual.
So. Yeah, I was actually out while you were partying in Vegas. I'd got something dropped into my lap, which was, we talked as you said last episode about the fund structure and how private equity gets paid, and there's essentially the 2% of the asset management fee, and then they get essentially historically has been a 2 and 20, 2% of the 2% management fee every year for what's being managed for assets under management, and then the 20% of the profits. Well, not 24 hours after we finished putting that episode in the can, I see an article on PE Wire that basically says management fees have fallen to their lowest level since tracking began.
Yes.
And we're seeing that 2 is now like 1 3/4, and a 20 in some cases is even lower than 20. It could be in the 15s or 10s. And I was having another discussion with a friend of mine in private equity this last week who said that the funds that were raised and deployed during COVID and post-COVID, late 20 through early 22 are just performing like dog shit. Mm-hmm. And they're having problems kind of showing return to the LPs, or having problems raising the next funds. And of course, we haven't gotten to that part in kind of the series yet, but that's how private equity stays alive. And so I'm curious, whether you were hearing anything in Vegas on kind of these issues, and what, if anything, it might portend for private equity, both for founders and for PE GPs and LPs, going forward.
Well, I got a lot of questions along these lines and had a number of discussions, not only about, what does the economics look like for private equity funds today, venture funds, et cetera, but also, what is the capital raising environment like, and how is that going? I think there's a few factors at play. one, you touched on it, is some of these vintage funds from pre-COVID, or, some that are long in the tooth from, 21. This isn't the best M&A environment that the world has ever seen, right? So, this is about the time where that vintage is starting to harvest and sort of divest and sort of take profits off the table, and basically start to, wind these funds down, move on to the next. Now, people are still raising funds, but they're extending the old ones, or the more, the vintages past the typical 3 to 5 year time frame to longer periods. So what does that do? That makes for a little more fundraising challenge, because typically you're going back to the same well with your LPs. And like, remember last episode, we talked about LPs being those pension funds, endowments, sovereign wealth funds, insurance companies, etc. And if their money's locked up in one fund, sometimes it's hard to get more money out of them. And I mean, anyone that's been in the business of raising capital, whether you're a founder in a venture-backed fund or whatever, or your own operating company, it's hard to go back to the same well if you've not delivered them their original investment back. So I think that's put some strain. There's still a lot of capital on the sidelines, but it's in order to raise funds in an environment like that, you do need to kind of, I guess, quote unquote, get creative on fee structures. So yeah, it sounds like fees have come down. Some of that also, I think, has to do with scale. The bigger you get, it's just a law of large numbers. Charging 2% on, a $20 billion fund, or $100 billion fund or whatever. That starts to look much more like a mutual fund size, where those fee structures are, 25 to 50 basis points, not, 200. So there's a lot of factors at play. But yeah, I think, for a lot of middle market private equity funds, that could be a big thing if they're having to take a hit on the fees. Hopefully they make that up on the profits.
Like, how big of a deal is it? I mean, obviously 2%, 1.75%, I think you said, Ed, on that amount is a lot, but it was every single deal right at 2%, or was there a little squishiness around the edges?
Squishiness, yeah.
Yeah, there's always been
technical term.
Yeah, there's always been some squishiness, and some of the funds, Emily, if it's a real specialty niche, they may be up in the 2% to 5% range.
Whoa.
Yeah.
And for others where it might be a debt fund, or leveraged loan fund, they may be sub 2%, or have historically been down to 1%. So it has varied, but the mentality has always been, 2 and 20, 2% for the kind of base management fee, and 20% for the promote, or for the carry, the part that's, kind of based on profit. The interesting thing is, probably, 20 years ago, so back when I was getting started, that 2 and 20 turned into 2 and 20 over. So you only get your 20% over a hurdle rate. So you kind of got to go, okay, it's 2 and 20 over 12%. So, you once you get the first 12% back to the limited partners, then you start seeing your carried interest, or your carry start paying off. And I think, what we're seeing in the market, and I'll give a kind of a real life example here in a minute. What we're seeing in the market from my seat is like, look, the debt markets suck because the interest rates are high, or historically, they're not historically high, but relative to the last decade, they're high. So it's tougher, kind of a finance geek, you're kind of pricing these things on a discounted cash flow basis, and your discount rate, or your risk premium, or however you want to describe the way you're valuing the business, is driven by a higher required return, because interest rates are high. So that drives prices down. So the market, sellers are more reluctant to sell because the valuations have gone down.
Mm-hmm.
Companies who were bought when the interest rates were 1%, now interest rates are 5 or 6%, are going, the company's got less value. Even if we've grown it, it may have less value today than it did when we bought it. So it's tough for the PE guys to get out of those companies, or certainly get out of it at a profit. And the the leverage piece that they use, so when they do the financial engineering and throw some debt on for the acquisition, that debt carry is getting more and more expensive, which reduces free cash flow. So I mean, it's kind of a I don't want to say it's a perfect storm, but it's a rough market out there, and the LPs are going, hey, we want, it's our money, we want our share. And yeah, you might not be seeing a lot of that promote because you're not going to hit the 12, but on the next fund, you owe back to us a little bit. And so we're going to take that, that
Why is the
quarter point
distinction
down.
between the debt market important?
So the debt market does two things. And the first thing, kind of as a practical matter, the first thing is a lot of the private equity funds will borrow a portion of the purchase price. And so, and when they buy the company, they go, hey, we're going to use some of the cash flow from the operating business to pay this debt down. So to service the debt. Well, most of the time that debt isn't like, if you go buy a house, you got a fixed rate mortgage, it isn't fixed rate. It's variable rate. And they may or may not have hedged, put a hedge on to protect their interest rate exposure. So in some cases, their interest payments may have gone from $80,000 a month to $270,000 a month over the last few years as interest rates have risen, which comes out of the operating cash flow of that business, which limits their ability to reinvest, to grow, to spin off dividends. So that's one piece. The second piece is a principle of valuation of any company is kind of this concept of I've got to get a certain return. And that certain return is, again, going to like finance theory, a risk-free rate
above the
plus
baseline
a risk premium based upon the riskiness of that particular asset. Well, if the risk-free rate, that's kind of driven by the bond market, the government bond market. So if government bonds have gone from a quarter point to 2.5%, the required return goes up by that same amount by, another 2.25%. And so now the discount rate's higher and the business's valuation goes down. Even if the business is doing just as well or better, the valuation goes down.
Translation, not the greatest thing in the world to founders, management teams looking for some compensation on a company valuation.
Not right now, no way.
There's a lot more cooks in the kitchen, and there's a lot more hurdles to be cleared before you see that dough down the waterfall, as you say. So I mean, so kind of going back to that compensation piece of it, you hit it. Like, the firms that have a specialization can still command the higher management fee. Like, I have a couple of, I guess you would call them closed-end private equity funds that acquire assets that are in bankruptcy. So we do something extremely niche-y. We're able to charge 2.5%, but we have investors that'll see headlines like what you talked about and say, I'm seeing now that the going rate for AUM fees is 1.75. Like, why are you charging 2.5? So that becomes a discussion that a fledgling fund like ours has to navigate, whereas people see kind of these macro trends and like look at it and compare it to a quarter trillion dollar fund. It's a bridge. This doesn't bode well for optics around small funds like this. So you got to specialize, and that's key in order to be able to kind of.
So like the standard is changing, it sounds like.
It is more at a more rapid clip perhaps now than it had been. It's always kind of been this baseline 2 and 20 concept, as we've talked about. That seems to have been the standard for many, decades even. But yeah, now it's there's different shifts in leverage, right? In which side of the deal you're on. So right now LPs have the capital, and there's more choice. And so, the sponsors, i.e. the private equity funds, have to make concessions. That's just how it goes,
So how does this compare with like the deals that we've been a part of, or you two have been a part of? Like you mentioned the different structure. I mean, what do you have to structure differently?
So there's a few things, I think, like in this particular article that we were looking at, I think the denominator for which the fees are measured against, is the commitment amount, right? So if a LP commits $100 million to a strategy. In this case, we're talking about charging 1.75% against that committed 100 million. What's the difference between committed and called? It means if I've signed on the dotted line as a commitment, it means that I'm reserving capital to be called by the private equity group at any point in time. Called means, hey, we're going to go buy a deal. You need to fund your commitment, right? So different flavors dictate kind of how the fee structure works. I think like the charging fees on the commitment itself is very private equity fund friendly, not as friendly to the LP. Whereas other strategies say we're only going to charge you a management fee on the capital we call. I mean, that's what my fund does. We don't charge a management fee on commitments. We put it on ourselves to say if we don't do deals, we're not earning a fee. So, there's different flavors of that. So 2.5% that we charge might sound high, but it's lower, relatively speaking, in the event that, we're compared against some that are not actually calling all the capital to deploy in deals. And so we talk about the M&A environment. The reason there's just not as many deals happening. So there's not as much capital being called. So private equity funds are saying, hey, we recognize that we're not calling and investing as much of your capital. Maybe in this case for this fund, we'll cede the rate on what we charge so that your capital doesn't fly from our fund to some other strategy,
Holy cow. Okay. So like if I'm a founder, I'm like thinking about this at a couple different levels, like macro economics. It's like, what is the market doing? Like, what are interest rates doing? Or is there any like crazy events happening that would move the market at that level? And then it's like, what PE fund am I working with? Are they large, medium, small? Are they boutique or specialized? Who makes up their LPs? And what's happening at that level? And then of course, for what's important to me as a founder is like, how does that affect my deal structure and how the PEs
exactly right. Yeah. I think what you're hitting on is really important for a founder and management. Again, working with a founder in these operating businesses, like, what is that dynamic behind my potential investor, right? Like my potential private equity, what does their dynamic look like? Look, like if you're dealing with an Apollo, there's nothing to worry about. They're pretty solid. But if you're dealing with a fledgling, PE group that's sort of at the table, maybe, really aggressively courting you, but it's hard to say just how deep of a track record they have, what their LP situation is. That's something to be cognizant of for sure. Yeah, because your success is going to be based on their success. 100%.
I was going to say two other things to keep in mind from a timing perspective right now is, as I had mentioned, the purchases that they made during COVID, so 2021, 22, before interest rates started to rise, they're underperforming on balance. So if you can afford to not sell, again, the private equity guys have long-term relationships with their limited partners. And if they got a couple funds that aren't doing well, they're going to be looking to get their next fund to do really well. So they're less likely to be paying you top dollar. They're less likely to be as aggressive. They need to get deals done, but they're going to be looking to hit long ball on this stuff versus small ball on the other.
Can you outline like at a high level what a deal looked like pre-COVID or during COVID, and then do one for now?
Yeah, I'll give an example. We were working on a deal. I was working on a deal with a family office out of the Bay Area about almost 2 years ago, and we were prepared to pay like 16x EBITDA on a manufacturing and distribution business, which again made me a little bit, as a hardcore finance guy, a little bit
That's
nervous.
Aggressive.
Yeah, but we did not get that deal. We were outbid by a private equity firm. Yeah, we were outbid by a private equity firm. Yeah. So it was a family office, and we were outbid by a private equity firm. That same deal today wouldn't trade at more than 11.
Yeah.
And I'll bet you it would possibly be single digits.
Yeah.
And the folks who bought it are not happy. We happen to, maintain contact with a couple of the members of the management team, and, they're not happy. And the issue there is, in order to get the deals done, there was a lot of capital running around, interest rates were low, and folks were trying to get capital deployed, and so they're like, okay, well, we'll buy with anticipation that growth is going to continue. Well, the economy's slowed a bit, interest rates have risen, their carry cost has gone up, and now that business is worth significantly less. And again, if you go from 17, 18x down to 9x, that business, the same business performing the same way, the value has dropped in half.
Yeah.
So are we still
leverage.
Are we still talking about the management fee or the fact that PE firms have different funds that are open? And
so it's a combination of things. So let me take a step back. These funds that were opened in 2021, 22 are underperforming today. So when the PE guys are going hat in hand to their limited partners and going, we need money for the next fund.
Yes.
The limited partners are they're saying two things. One, those other funds aren't performing well.
What Rory said, yes.
So you need to cut me a deal on this one because
Okay.
I'm not making as much. And two, whatever you're doing in this fund had better be better than the crap you did in these last couple of funds. And so if you're a founding management team, this is probably not the ideal time to be selling, because the private equity folks need to be able to kind of recover their performance, hit their performance targets. So they need to pay less. The interest rates are up, so they're going to be, the multiples have gone down. And as a management team member, you may be better off going, okay, can I push through for another year or two until interest rates come down before I go to market?
Yeah. Okay. So I mean, that speaks to a few things. Private equity, again, you think about these things as I'm buying company A, company B, company C, you think about it on like a singular basis, but at the end of the day, these are parts of a portfolio. So these cumulative deals are looked at as part of an overall portfolio. So if you're overperforming on one part of your portfolio, you're trying to make that up on, let's say, investments today that offset that, right? So ergo, you're trying to buy deals at a steeper discount, basically. And so, you touched on sort of the environment as well. Maybe not ideal, but shoot, it's still more ideal than trying to go public right now. That's all but dried up. So I think the theme that we've talked about in our book, and we touched on even last podcast, I think a little bit, was like private equity still is in many ways the most frictionless way to realize value on a business you've built. So all of that to say, like, the private equity group's always going to be trying to, figure out how to make their own money, both on the LP side and the investment side, because they make most of their money, of course, still on the profitability of these businesses. So, it all works together. But I just think that right now is an interesting time because, we have been in this high interest rate environment, political uncertainty, a lot of money on the sidelines still, but, it's almost like the skids need to be greased to get the whole system working as efficiently as we've been used to over the last 10 to 15 years, really.
Okay. So if I'm a founder and now I understand, all right, I kind of have to be aware of what's happening, not like directly impacting me, but like indirectly it is. I'm going to try to break down what I think I just heard. So during COVID, PE firms made investments in funds, and those companies underperformed because COVID sucks. And so when they open, okay, someone give me like the 10-second answer of like why they underperformed then.
They underperformed because interest rates went up and they overpaid for them during COVID.
Well, okay, so interest rates were going crazy because of COVID was doing.
What you're talking about, Emily, is actually, a double calling it creates a double negative. So like, okay, Ed was talking about it as if like business is performing just as it was, but what you're talking about actually makes that even more of a hit, like a negative.
It was like a double stacked against you environment. Yeah. So then when PE firms go, LPs, we need some more funding for the next round, come on down. They're like,
They're not as quick to open up that checkbook right now.
My money's still tied up over here. It's not doing so well. So I want a discount on this other next round.
Buy one, get one at a discount. Exactly. Okay. Just like you'd go to the grocery store for, whatever snack you like, It's like,
okay. So that makes sense to me. So then the PE firms go, okay, I'm going to go from 2% to 1.75 on your management fee. They go, okay, fine. As a founder, I need to be aware of that. Is it more so for like trying to exit? Is it more like, where does that affect me most?
So as a founder, it's less, the effect is less direct. I mean, you're not being impacted by the LP fees. You're not being
Right,
impacted.
right.
What you need to be aware of as a founder is that private equity fund is under tremendous pressure to perform right now, more pressure than they've been under for
Yes,
a decade. And so
Okay.
they're going
that's it.
to structure their deal to ensure better performance.
Ah, so on
And
your
again, remember,
side,
this is
yeah.
kind of a zero-sum game. Any gain on one side means, seeding something on the other side. It's, you can't, it's not a perfect hedge, right?
So you're going to get, in general, statistically speaking, you're going to get a less favorable deal on your end because they're
Yeah.
going to try
yeah,
to make up
today,
for it.
correct. Yep.
Yep.
Yeah, exactly
Okay.
right.
So they're getting crunched on the LP side. So they're going to try to make that up on your side,
Yep. On
Yeah.
the carry.
on the company side. Okay.
Yeah.
Rory, can you break down Carrie? Can you break down what Ed
Sure.
just said?
No, it's just we'll keep coming back to this, in these carry simply means the private equity groups call it participation in the profitability of the business. So like if the business is sold at a really good price, then private equity group participates in the profits that are delivered to the LP from that deal being so good. So like here's how it works. Like on my fund, we have a participation once our investor groups hit a 10% return. So anything above a 10% return, we participate. It's called carried interest. We have an interest that we have in our investors' profitability, basically. So we share in their profits.
So if it hits that threshold, you
Yep.
get interest payments.
Yeah.
You, like,
Yeah.
are they like dividends, or are they just like you get?
Yeah,
Okay.
exactly. It's
Yeah.
I mean, technically it's just a share of the distributions, but it's, how you characterize it. Just think about it as participate in the cash flow. That's the easiest way to think about it.
Now,
Yeah.
do you have the option to reinvest those in the business, or do you pocket them, or do you have choices?
Yeah, I think, well, so depending on the structure of the fund, oftentimes there is reinvestment, or at least for a period of time. Like in our funds, there's a period that's just the investment period. So any dividends, or I should say cash flow that's available to be distributed, gets reinvested in assets for a period of time, but not forever, because as an LP, eventually you want to see some cash flow, right? So that's the whole purpose of it. So yeah.
Okay. I'm still trying to like find a succinct way to say, why are these management fees falling? Because it made the news, like it made your.
I think it's more relevant just for people in the private equity side of the coin. Not, it's, as Ed said, the impact to founders, management teams, people in operating business, it's indirect.
Yeah.
I think it's just interesting because we're sort of seeing a trend that's been different than what we've seen for many, many years. And anytime you see the market going rate for asset management fees under private equity managed funds decrease, that's a big thing, because it's been such a ubiquitous 2 and 20 dynamic forever. So you just naturally want to think about, well, what happens now? Like, what does that mean?
Can it go back up?
Yeah, absolutely.
Okay.
Absolutely.
So
one thing that's certain about private equity and the very, very smart people that are in that world is they innovate. They figure out ways to create new value, create differentiation. Like Ed said earlier, if you're a specialized fund, you can command higher fees. Some of them, and this is kind of in hedge fund territory, but I mean, some of the hedge fund fee rates are really, really high because maybe they're, high frequency trade. I mean, just super specialized stuff that somebody's willing to pay for, because it's high value and you're delivering high returns. At the end of the day, it's all commensurate. Remember this is as basic as it gets. Fee structures are aligned to investor returns. It can't be out of whack. Otherwise there wouldn't be a business. So investor returns go up, then, private equity makes more money because, everyone is happy when they're making money. And so you can command more fees. If it's tough environment to realize ROI, then fee rates have to go down. It's just the law of supply demand,
So to turn the tables a little bit, if you were talking to a PE firm or like a managing director of a PE firm in this environment, and they're asking you how to, like, what do I do? How do I structure this? What advice would you give them?
Ed, you might take that one.
Yeah.
You're a master structurer.
Yeah, master structure. If I were sitting on the other side going, guys, right now it is a buyer's market for businesses. So PE firm, if you have skinnied yourself down, you may want to go, hey, I'll take 1.5%, 1 3/4 on the asset management fee, but I'm going to push the promote up, or I'm going to push the carry up to 25 or 22, so that I'm more aligned with the limited partner. So I make more money when the limited partner makes more money, but I'm going to make up the difference on the profit side. So I'm not giving up the dollars. I might just be deferring them with a potential of a higher up if I really perform well.
Okay,
Yeah.
so I got 1.5.
Higher upside on the percentage profit share, the carry, as we talked about.
Yep.
Okay.
Maybe lowering the hurdle rate too, for which you start to get compensated. I mean, a lot of times, it could run the gamut. Like I said, our funds are like 10% is our hurdle rate, but I've seen funds as low as 5. So, you'll find, if it's let's just say if it's a tougher environment to make money generally, then a lower hurdle rate for which then, the PE group can share in the profits of the LPs makes sense. It's just, there's a baseline economic state of affairs, and everything like, risk-free rate, all this stuff is benchmarked around that effectively. I mean, like it all works together,
Well, it sounds like you're still being incentivized in alignment with the LP. It's just
have to. Like Rory said, if you're not, there's no business.
You've moved around kind of where and when that happens and how that happens. Would you, Ed, would you suggest the PE firm does anything specific with like the companies they're working with on that side, or is it all kind of rejiggering with
No, they're gonna be working, on that side to refinance, re-engineer, renegotiate covenants, and then give themselves some flexibility on the debt side for their existing portfolio companies. The new companies are taking on, they're going to lever them differently, and are going to go in with a different strategy that isn't necessarily a debt driven value optimization model, because it may not be. They're probably going to be looking more at what kind of operating efficiencies, what kind of growth, what kind of organic growth can we get out of this business, more so than how much debt can we throw on this to be able to drive the return on equity up.
Oh, I was just going to bring it back to kind of like, once again, talking about, the ability of an operating company to be more and more profitable just means more and more value to, at the end of the day, the LP that's, committed the capital of the PE group who's invested it. I mean, it's all this virtuous thing. Like, so as Ed's saying, you do all these things at the opco level so that you can make it more profitable for the PE group, and then the PE group can share in more profits, with their LPs.
The circle of life, Simba. Everybody wins.
It is the circle of life. For some, the circle of death. It is really just. It's always just these pieces moving within this ecosystem that just says, okay, where's the benefit going? At the end of the day, it's always going to be aligned to the benefit, or at least structured in a way that the LPs, make the money. I mean, because without their money, none of this happens.
Nothing happens.
Straight up.
At the end of the day, though, Em, it's gotten harder. So, I mean, fundamentally, it used to be when you could borrow money for 3%.
Yeah.
You go, okay, this is easy. I'm gonna pay as little as possible. I'm gonna put some leverage on the business. I'm gonna get a good return on equity, and it's done. And if you don't achieve the operational efficiencies, if you don't really grow, you can still get a decent return out of that business. Now, the strategy going in, and we talked about, private equity goes in with a strategy. They're never like, well, we're gonna buy it and see what happens. I'll bet you dollars to donuts that strategy right now is far more driven around how do we drive operational efficiency? How do we drive organic growth? How do we be capital efficient, and not as much about how do I throw debt on this business and service that debt to be able to kind of bring my purchase price down and get a higher return on equity. It's got to be more on the operational side.
Yeah.
So is the main form of debt in what you're talking about a bank loan?
Yeah, it's normally
really.
Yeah.
Yep.
Bank loans and nowadays private credit funds. So
'Cause-
non-bank lenders. But yeah, let's just put it this way, Emily. That's called the credit markets. The world of debt is orders of magnitude bigger than the private equity world. It's massive.
Because
Massive.
like earlier Ed said covenants, and I had like flashbacks of
Yeah.
like you and Rory and Glormar and like our PE firm, like we're gonna
Yeah.
bust covenants, and that was like the end of the world.
Yeah,
So
no,
we
it
might need
gets
to
a
do
little
a
bit
whole
gnarly at times like this,
episode on that.
it's like a little more, a
But
little hairier, but yeah, but that's just the cycle of business. It's the cycle of life, right? Like it's always
yeah.
cyclical.
But
It's never.
also like in that the interest rate affects the bank loan as well. So it's you're kind
Oh,
of
totally.
the
Yep.
macro
Yeah.
economic piece of it. You have to be aware because it hits you in these different points.
And there was a lot of folks that back for the last few years, they didn't put interest rate hedges on because they're like, well, it's going to be fine. And it costs money to hedge your interest
Yes.
rates. And so they were like, no,
Oh, no.
we see stability. Well, all of a sudden the interest rate starts taking off and they're like, well, and it took off fast. I mean, the interest rates rose quickly and they ended up flat footed. And now they're stuck with, you can't hedge against,
Yeah.
they're hedging at 4%.
Didn't the interest rates go negative in certain countries somehow?
The like the equivalent of the Fed funds rate, but
The effective,
the effective interest rate was so low that a lot, and again, every one of these things, if you're going, well, I'm going to hedge my interest rates, you have to buy the hedge with the bank. You negotiate it with the bank. So folks are like, well, why would I want to spend that money? I don't see the interest rates going up anytime soon. So it gives me a better return. Well,
it's
when
greediness.
they flipped that,
truly greediness. Like
in like just a couple quarters, the interest rates went way up, like very quickly. That caught a number of companies that didn't have a hedging strategy flat-footed.
Yeah. It's like it always follows the same thing. It seems like there's these cycles go to where I don't know, like there's a level of complacency at a certain point. Things are so good, there's no way it could possibly swing so far the other way that we get slapped. And then, but sure enough, it does, and you do
COVID
get slapped.
just bitch slaps you. Yeah,
but I think corrections like that are critical, but it happens, it's a normal part of thing.
It's almost like every 10 years, like clockwork.
Yeah, I was just going to say
8 to 10 years.
Trying to do the kind of.
And I'm sitting here, I got gray hair, so I've been through like 4 of these, and I'm like, it's about every 8 to 10 years, like clockwork.
Yeah.
The business cycles, and folks are like, we never saw it coming. Where as you're getting old, you're like, no, I can see this. I see it coming, and you guys are getting too aggressive.
Yeah. So you never know. Like we could be sitting here 10 years from now saying, wow, management fees on average are 4%. Why is that? Well, it's because Blackstone and KKR have acquired every other private equity firm in the world.
Oh, God.
And it's only 2 of them. And now they have the pricing power. Who knows? Like these things can swing both ways if you want to think about it.
So let me wrap this up, and almost like it's a tee up for a future episode. But for like the debt side, the PE firm.
Ooh, I love talking about debt. That's my favorite. So.
You get so excited.
I do.
So the PE firm, when they're doing a deal, they'll take out a loan from a bank, and the terms they negotiate with them are key to how the deal is structured. As a founder, you best be aware of how that's structured, because if like the interest rates do a roller coaster on you, that crunches your forecast, and that means you're going to have to operate differently. So that's like a whole other.
Well, we have a whole section of that in our book, plug, but yeah, that is, you mentioned what's direct and indirect effect on these businesses. Absolutely. The leverage leverage equals debt again. That's placed on these businesses usually at the time of acquisition by a PV group, that is directly impactful to the founder and what they've been used to. 100%.
Yeah.
They're at the top of the waterfall with the best vista.
Yeah. Well, I mean, they get paid first. And I know that in some scenarios, like if the company's not doing well and you're not able to pay back the bank, they'll extend the loan to you, but the interest will be higher, and so it almost
Oh, yeah.
it makes it worse.
And they'll charge you a fee for the privilege. And see what the business, what the bank does
Every
not
time
want
a covenant is waived that you've busted or whatever,
Oh,
you get charged for that.
is write a check.
yeah.
What they will not, what they do not want to do, and this is a whole nother episode, is take the business. So they don't want to force you to bankruptcy. They don't want to take the business. They don't want you to toss the keys at them, but they will extract every pound of flesh that they figure they
Oh.
can, including renegotiating that loan in order
Yeah.
to be able to make sure they get paid back.
Yeah.
And again, I've been in this situation once where negotiated with the bank to buy us time to get the company sold.
Yeah. Or
So, I mean,
basically, put it to the ownership group to put in haircut money, right? Like
Yep.
to top up.
Yep.
So that
Been there
means
too.
that if that means, we talk, again, prefacing some of the book, we talk about concepts like drag along, tag along. If you're in an ownership group and you're party to a bank loan, there's you may need to contribute more equity at some point to top up if you're using a borrowing based scenario, like the advance rate. I mean, this is a whole nother episode, but yes, these are absolutely things that a founder and the management team need to be aware of and understand deeply in these
Yes.
deals.
So
and I
basically,
love talking about
listener,
this stuff.
you have gotten a preview of an upcoming episode. So
Yes.
if you would like to know more, then tune in next time to the Private Equity Experience podcast. Ed,
Yes.
Rory, any last thoughts on management fee or what that means or what people should know, why that's newsworthy? We covered a lot. Just anything
We covered a
else?
lot. We jumped around. Not really. I think it's important for us to just kind of keep on current trends and look ahead. And what does it mean what do these trends mean? I guess that's the
Yeah.
point.
Yep.
And I think
Second, third layer effects of what you're seeing in the headlines.
Yeah.
Yeah. And I think, we're going to be doing episodes on the trending topics. And if one of us comes across a news story that we think is important for you to know about, then we'll kind of discuss it as a group here and you get to listen in.
And if you, viewer or listener, have interest in things that you're seeing and you'd like us to expound upon, we love doing it. So hit us.
Shoot us a note. All our information is in the show notes as always. All right. Talk to you guys next time. Bye.
Bye.
If you enjoyed today's episode, please like, share, and subscribe wherever you get your podcasts.